With markets continuing to roil, headlines continuing to scream, we're going to talk about how avoiding all pain can bring on the danger you fear most. Even as we shoot this video, you've got announcements coming out of the White House. You have new developments in the Middle East, economic data pouring in. It's got markets roiled, big up days, big down days. It's got people pretty unnerved. We're going to walk through it. We're also going to leave you with two main things if you stick around. One, how not following typical investor logic could help enhance your returns by over 5 times, historically speaking. And two, give you some reasons for hope from some analysts we respect and trust. The point of this week's commentary, again, is getting through the pain. Michael Gayed, a market commentator, award-winning researcher, shared this week a post kind of around the same topic I wanted to share. It was a little bit of some of the lessons he learned losing 100 pounds through fasting. And he had this great quote, which we're going to put up on the screen for you right now. He talks about his fasting and experience and as it relates to investing with his epiphany that you realize the pain was never the danger. The panic response was. Markets work identically. The drawdown doesn't destroy you. The panic sell at the bottom does. The force rebalance at the wrong moment does. The decision to stop the pain by locking in the loss does. Discipline isn't about ignoring pain. It's about not confusing temporary pain with permanent danger. Love the quote. We've used that same line of logic countless times in talking with clients. I've used the analogy that, I love nautical analogies when it comes to investing. You're in the boat, the waves are crashing, the storm's going, and you feel seasick. And you often have that feeling as an investor. It is less volatile at the bottom of the ocean should you jump out of the boat. But it's far more dangerous to do so than to stick with the ship. But we see that with investors time and time again, particularly around the time markets have dropped 5%. Got down about 8 in February. We've been hovering around that 5% mark here for a little while. It's the time where people begin to hit the panic button. We hear the lines of logic saying, hey, I want to get out before it goes deeper. I'll get back in when it's calmer. That sounds logical, and yet it presupposes 2 big things. Number one is that it's going to keep going down, and most 5% declines do not turn into 40% declines. The second thing is that you're going to get back in, or you're going to feel calm, or that things are calm, at a price that is still below the price you're getting out. If not, you're losing. And I promised you how that logic leads to a lot of potential losses. We're going to pop a chart up onto the screen right now that shows just that. From 1990 to present, if you were to get back out at a 5% drop and get back in at the time the market got back to its all-time high, that would have cost you about 80% of your potential return in the S&P 500. And yet, that's the reality, or often the result of employing just that kind of logic. Same goes for people who want to hold cash. We'll pop another chart up here in just a second, but it's the same kind of notion of, hey, I don't ever want to feel that volatility. I don't ever want to feel that hunger pain. You can eat and make sure you never feel that hunger pain. I think we all know that that isn't the healthiest path as an investor either. As this chart shows, inflation has that powerfully erosive impact on one's purchasing power, which is at the end of the day, why we're saving this money, is to provide for ourselves and those that we love. And so again, much like hopping off of that rocking ship for the peaceful bottom of the ocean, it might feel calmer for a hot minute and then the real danger sets in. So too, holding all your money in a non-producing asset for long periods of time produces the very kinds of danger, the very kinds of loss to one's purchasing power that most people live in fear of with respect to the market. So at this point, you might be asking yourself, if we stayed with the ship, will the storm ever abate? Of course, I cannot predict the future exactly any more than your local weatherman. All due respect to the local weatherman. But nonetheless, just like being prepared for the variety of weather that can come, the surprise storm, the shift, unseasonal change, so too we can be prepared as investors. And just like the weather, markets do have their storms, do have their surprises. In fact, a lot of people are surprised to learn that approximately 45% of trading days, about 1/3 of calendar years, result in negative returns. And with that kind of large percentage of days and years yielding negative returns, I think a lot of people would logically conclude that, man, investing must not work, or the returns must be pretty tepid. Of course, if you look back here over the last few decades, the market has historically averaged, at least since the start of the S&P in 1957, right around 10%. And so again, the storms happen, the bad weather happens, things still grow given time, just like they do in the real world. So what signs of sun do we have that might help lead or cause that growth to occur? One, fourth quarter earnings and even first quarter earnings estimates continue to be strong. According to Jason Trenner of Strategis, both coming in right around 14% gains year over year. A good sign for market. Stated before, the old Benjamin Graham quote, in the short term, the market is a voting machine, i.e. emotional. Long term, it's a weighing machine. Earnings, those earnings continue to be intact. Many would question, can that still happen with a $100 bottle of oil? Wanted to share these 4 great points that we'll put up on the screen for you from Tom Lee of Fundstrat for reasons to be optimistic even at $100 oil. He points out that even at $100 a barrel, on an inflation-adjusted basis, that's lower than the actual average over the last 25 years. Points out, unpleasant as it may be, that U.S. war spending is actually stimulative to the economy by about 20 to 30 billion per month. And that oil would have to average, point number 3, 125 a barrel to begin to offset that gain to the GDP. And lastly, and we've shared these charts a few weeks ago, if you want to go back and find that commentary, equity markets historically bottom after about the first 10% of the duration of whatever conflict is going to be, i.e. before things feel better, as we alluded to that logic earlier, markets usually begin to bottom out and begin their new ascent. You throw in addition to that, this week's retail sales data, which showed another gain of up 0.6%, the third consecutive month of gains in U.S. manufacturing. Again, there's lots of things taking root that, again, should begin to develop in time. In closing, market pain is real. Going through that pain is real. But like so many painful things that we've got to endure in life, a painful workout, the pain of a little bit of a hunger, they can lead to good things given the discipline and patience to see them through. Investing is no different. If you need help setting that plan, plotting that course, and a partner to come alongside to take that journey with you, we're here for you anytime. Thanks so much.